Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. This is the week that a certain bulge bracket firm downgraded its forecast for the S&P 500 and laid out scenarios, all plausible, for the rest of the year that would result in the S&P being up 26% or down 18% or somewhere in between. Now that's a lot of uncertainty that's sure to fuel plenty of volatility. All right, let's get started. This week our three things are: 1. Equity volatility. It does bleed into credit spreads. It's worth keeping an eye on. 2. Bank examiners' view of credit risk. It doesn't square up with what we're hearing from the banks. And 3. Supply chains. Here's an easy way to mark their progress in opening up. Let's dig a bit deeper. We spoke the other week on the relative durability of credit compared to equities, how credit spreads have held in relatively well in the midst of the powerful sell-off in stocks seen in January. But even credit succumbed to investors' cumulative angst driven by Ukraine, slowing economic growth, and the prospect of future rate hikes. And oh, by the way, angst is easy to spot when high-yield spreads were sitting at or around 15-year tights. So conditions were ripe for a bounce, and a bounce we did get. From 271 basis points on December 27th out to 367 basis points at the end of last week. Now, interestingly, the VIX also peaked around the same time at 32 on the 26th. Since then, the VIX has plummeted to 20 before bouncing again to 26. There's that volatility. Yet high-yield spreads are still out near one-year wides. And that begs a couple of questions. Is credit seeing something that equities isn't, or is credit oversold? On our KBRA Altman data analytics platform this week, by the way, you can find that on the KBRA Altman tab on our website, kbra.com, we acknowledge that credit market developments are often the proverbial canary in the coal mine for broader risk markets. And in this instance, we believe wider credit spreads are pricing in additional risk coming from the macro and geopolitical developments. That includes an increase off the bottom in one-year recession probabilities that we spoke about last week, the aforementioned concern related to a Russian invasion of Ukraine, as well as disturbing developments coming out of Iran and its pursuit of nuclear weapons. But we're also quick to point out that spread widening needs to be kept in context. We are basically bouncing around the tights. From 2010 to February 2020, the post-GFC period up to the pandemic, the average high-yield spread was 478 basis points and the low 303. So today's 352 basis points is well through the average of the period. So to answer those two questions, we do not think credit is seeing something equities isn't, and yes, the VIX settling down, at least from its January wides, you can make a case that credit is modestly oversold. All right, on to our second thing, bank examiners' view of credit risk. We know that credit quality, according to bank lenders, is in great shape, if not historically so. That's the nearly universal view that emanated from Q4 earnings calls from the banks themselves. But what did their regulators say? This week, the three primary federal bank regulators, the Federal Reserve, the Controller of the Currency, and the FDIC, weighed in, releasing results of their biannual SNC, or Shared National Credit Program. That's where regulators review loans $100 million or greater shared by three or more regulated banks. The results of this latest iteration reflect loan reviews conducted in the first and third quarters of 2021. In the regulators' words, credit risk remains, quote, high, largely due to the impact of COVID-19, unquote. For context, consider what we would describe as concerning but generally performing, plus deteriorated loans account for 10.6% of total commitments compared to 22.3% in 2009, the recent peak hit in the wake of the global financial crisis. If we look at just the deteriorated category, known as classified credits, that figure is 6.4% today versus 15.5% back in 2009. The report did note that risk improved modestly in 2021, driven by the recovery in the oil and gas sector. The direction of risk in 2022, the report goes on to say, will be impacted by the pandemic, inflation, supply chain imbalance, labor challenges, high debt levels, and vulnerability to rising rates. It's quite a list, but nothing especially noteworthy there. Regulators did single out leverage loans as a concern, as you would expect in almost any regulatory report. There is not much incentive for watchdogs to say, yeah, there's not much going on in riskier credit. Leverage loans represent half of SNC commitments, but 78% of so-called classified loans, those credits that represent a range of deterioration. Interestingly, a bright spot was commercial real estate, where only 5.6% of commitments were in the deteriorated category, a figure that is well below the total SNC average, excluding CRE, of 6.5%, and well below the 23.1% peak following the GFC hit in 2010. So while the CRE story is not fully played out, it is reassuring to see that bank credit experience, including harder COVID-hit sectors such as office, hotel, and retail, has not in the aggregate deteriorated appreciably. So all things considered, the high credit risk regulators are seeing doesn't really strike me as all that high risk. All right, on to our third thing, taking stock of supply chains. Now, much attention, of course, is focused on the demand shock in the economy and just how and when the Fed will address that. Volatility in markets is very much driven by that uncertainty, with a bit of Putin sprinkled in for good measure. But the other part of this economic landing equation, soft or hard, is what is happening on the supply side. There, operational efficiencies, COVID-related impairments, and far stronger than expected demand for goods has overwhelmed existing supply chains and their ability to meet that demand. This story, of course, is a big part of the inflation narrative. Now, our view continues to be that capitalism and science, i.e. pandemic management, will eventually fix the supply side issue, while the Fed does its part, cooling demand. So how is the supply side issue doing? Well, in short, it's moving in the right direction. ISM manufacturing supplier deliveries slowdowns has improved from nearly 60% in May to 34% in January, and order backlogs are slowing. Port backlogs have reduced by about 2/3 from the peak seen last year. And we can see this anecdotal improvement take shape in the New York Fed's Global Supply Chain Pressure Index, which rolled out January 4th. The index integrates 27 variables drawn from cross-border transport costs and country-level PMI surveys. A reading of 0 is average, and standard deviations above and below average are calculated. Needless to say, the index, with data going back to 1997, has never approached the levels seen in the pandemic era, with its high peaking in October 2021. The good news is that the index has fallen in November and December. Now, to be clear, a couple of months does not make a trend. We've certainly learned that over the past 2 years, but it does suggest that solutions to this well-publicized problem are starting to make a difference. It will be a big part of bringing inflation under control. Keep an eye on the New York Fed's Global Supply Chain Pressure Index. So there you have it. 3 things in credit. 1, equity volatility. It does bleed into credit spreads, and it's worth keeping an eye on. 2, bank regulators say credit risk in syndicated lending is high. Given the economic forecast and where that risk sits today, we think that characterization is a bit hyperbolic. And 3, supply chains. With all the attention focused on the Fed, don't lose sight of improvement to the other half of this inflation story. As always, thanks for joining us. Don't forget to check in on KBRA.com for our latest rating reports and research. See you all next week.